Hey, hi, this is Gautam. I'm back. So in this video, I am going to value a healthcare, an Indian healthcare provider, which is Kowai Medical Center and Hospital, which is based out of Coimbatore. Okay. So this video is meant for students who intend to build a career in valuation or equity research, or even for working professionals who intend to pivot to finance, to valuation or equity research per se. All right. So before this video, I've made a couple of videos on. One was on understanding financial statement, the balance sheet, the P&L, cash flow, and how these statements are linked together. Okay, that was one. Okay, and the other was on financial statement analysis or financial ratio interpretation of the same company that I'm going to value today. Okay, so yes, so if you are a serious learner, if you really are looking to learn, so I would strongly recommend that you watch the video on financial statement analysis of this healthcare provider. Okay, because that's going to set the stage up for this one. Okay. All right. Because I'm going to use some of the ratios that I had estimated and interpreted in that video in this one. All right. Okay. And one thing more. So I know I'm covering, valuing a healthcare provider right now, but I intend to cover, I intend to uh, make financial statement analysis and valuation videos for companies operating in other sectors as well. In fact, 3 years back, I did make a valuation video on a US retailer, Costco. But that time, I did not really have this intention of making an education video series. All right. So I did cover retail, but again, right now I've started with the healthcare company, but I'm going to foray into other industries as well, like retail, manufacturing, FMCG, and yeah, financial services, like insurance, banks, and asset management companies. Right. Right. So I'm going to cover most of these industries as well. Right. So, all right. So this would be in this video series would be a lengthy video series. So again, hoping that you are a serious learner. Okay. And I'm going to be very hands-on in this series. What I mean by that is that, see, valuation would has a lot of concepts. DCF valuation has a lot of concepts. So instead of throwing a bunch of theory at you upfront, okay, what I intend to do is I would cover the different various concepts, practically. Okay, how do you kind of so I'll explain those concepts as we go along. Okay, and then how do you like apply them? Okay. So again, I intend to be as hands-on, as practical as possible. That's why I'm kind of taking this case study, approach of explaining this concept, because otherwise valuation could be pretty overwhelming. Okay. All right. So with that said, these are the topics, learning objectives that I intend to cover in this video series. Let's start with the introduction to valuation. Again, this topic is just the starting point. I'll just kind of explain you like what is valuation, and without using any finance jargons, how do you kind of value at a very high level, and then talk about the industry of governance of this particular company, which perhaps is very uh, perhaps the most important aspect, especially when you're talking about small companies. Okay, and then talk about getting into the financials, right? Revenue, cost, and so on and so forth, and then actually valuing the firm in bullet 8 and bullet 9. All right. Okay. All right. So with that said, let's get started. All right. So now starting with introduction to valuation. So let's understand like how do you value a firm at a high level, and obviously we'll get into details later in the video series. So value of a firm or business or an asset is the present value of its future cash flows, right? So when you value a business, you have to understand and estimate the future cash generating ability of that business, and what is the worth of that future cash today. फ्यूचर में जो कैश फ्लो आने वाले हैं उसकी वैल्यू आज की डेट में क्या है, राइट? ओके, सो लेट मी talk about some of the ingredients, okay, that you use to value a business and how those ingredients are kind of mixed together, right? Okay, so all right, so the first thing that you need is you need to project out profits, and to project out profits you need sales. You need to project out sales uh, in the future for a certain period. Now, we'll cover what period later. Okay? But first, understand we need to project out sales. Okay? And we obviously need to project out cost. That's how you get to profits. Not getting into, sorry, it's bad handwriting. So, not getting into what profits, gross profit, operating profit, and net profit. But now, just understand you need to get to estimate profits for a certain period in the future. Again, we'll talk about what period later. Okay. So you need profits. Okay. And then see, firm, in order for a firm to or a business to grow, it needs to put money back into the business, right? Okay. And that money could be, the firm may want to say purchase a building, or set up new offices, or purchase a plant, or buy more machinery. Okay, because using all of this, it would be able to expand its business, perhaps make more products and get more sales in the future. Okay, so it needs to make this capital investment, and this has long term implication. ऐसा नहीं है कि एक बार machine कोई खरीदी and they're just done with it for that year. Obviously, that machine, they're going to use that machine for the future years and get sales in the future years. All right. So it has a long term implication. So any capital investments, okay, need to be netted off, okay, from profits. Okay. So, so any capital investments need to be netted off. Okay. And how do they fund these capital investments? They could fund these capital investments through their own profit. Okay, if they are sufficient, if the profits are not sufficient, they could borrow money from the bank as debt, or they could reach out to shareholders. They could give shareholders more ownership in the business in exchange of some equity, So that may happen. That's how you kind of fund these things. All right. So, so you net out capital investment from profit. Okay. And then the other thing is you also need to net off any change in working capital. Now, what is working capital? Okay, and again, keeping it very simple right now. So, see, short-term liquidity is what is working capital. All right, now get the notion. All right, say if you make a sale, okay, you make a sale of say $100 in a financial year. Okay, the your customer, they paid you say, let's say $100. Okay. So $400 worth of sale has not been paid yet by customer. Okay. But the profit from that $400 sale, or that overall $500 sale, you have already recorded in your books. Okay. But you don't have the entire profits with you in your bank, in the business. Okay. Okay. Because that money has not come from the business, although you've recorded the profit. Okay. So there is some money which is stuck, with your customer. Okay, so think of that as think of working capital as money that is stuck, okay, with some party. All right. So hope you get the notion. Again, we'll get into some details when we kind of value this company. Okay. So the other thing that we need to net off is change in working capital or short term liquidity. Because see, the example that I gave is a short term liquidity. The customer is going to pay, but not right away. The customer will pay like 2 months later, 3 months later. So the nature is short term. This is more long term. Okay. Whereas this is more short term. Pardon for the bad handwriting. All right. So after you kind of net off these two things, what you're left with is free cash flow. Okay. This is what is used to value a firm. The value of a business is the present value of its future free cash flow. Okay. So this is the surplus cash that a business is left with after meeting its uh, capital investment and day-to-day working capital needs. That is what is free cash flow. And that is what is estimated, okay, in valuation. Okay. All right. Now, so this is one part. Okay. Remember, I said valuation is the present value of its future cash flows. Okay. So we also need to kind of understand all these free cash flows which would be generated, say, in the future. Okay. What is the value of all of its future free cash flows today? जो फ्यूचर में फ्री कैश फ्लोज आने वाले हैं उसकी वैल्यू आज की डेट में क्या है वो भी तो एस्टिमेट करना है ना. सो दैट इज स्टेप 2. Okay. All right. So let's talk about it right now. Okay. All right. Let me get it on the board. All right. So let's talk about that step 2. So let's say the business after 1 year, it generates, let's say, $100. Okay. All right. So today, like year 0, what is the value of that $100 today? $100 would be generated next year. What is the value of that 100 today? कि जो $100 जनरेट होने वाला है अगले साल उसकी वैल्यू आज क्या है? Okay. Say, let's say if the inflation is 4%. Okay. तो आज की डेट में उसकी what's the value is divided by 1.04. Okay. So $100 next year, okay, it's worth $96 today. All right. So basically the stuff that you can buy for $96 today, that stuff you can buy for that same stuff, you need to pay $4 more next year. So that is what is inflation. Okay. At 4% inflation. Okay. So that's why we need to estimate the future cash flows and discount them to the present. So there is a discount of $4 here. Okay. So here we just spoke about inflation. Okay. We just spoke about inflation. Oh, okay. See, when an investor invests in a company, okay, they not only uh, discount the future value just using inflation. Okay, there are a couple of other things as well that they add to inflation. And again, just trying to keep it very simple, just so that you kind of get this notion of time value of money. Okay, and time value of money is essentially what we're talking about, right? So inflation is one thing. The other thing, okay, is they also, along with inflation, think of, real GDP growth rate. All right. And what is real GDP growth rate? You would have heard of that example. Say if a country, uh, the only output that the country produces is apple. That's their only product. Say if in 1 year they produce 100 apples, and assuming price remaining constant of those apples, say if they produce 100 apples this year, next year they produce, say, 103 apples. So the three apples more. So 3% is their real GDP growth. Okay. So along with inflation, okay, there is real GDP growth rate. Okay. Okay. So investor adds that as well along with inflation. And the third thing uh, and by the way, let me actually go to whiteboard. I think it will be clearer. Uh, yes. Okay. So let's say inflation is 4%. Okay. That is one discounting. The other is real GDP. Okay. Let's say that is 3% growth rate. Okay. So this 7%, think of this as, loosely, in fact, think of this as government bond yield. And again, abhi samajh mein nahi aa raha, don't worry about it. But see, inflation rate is demanded, real GDP rate is demanded, okay, which is think of this as government bond yield. Plus, along with that, okay, see, if they was just demanding 7%, they would invest in, say, a government bond, and get that interest, right? Why they would invest in the company? To invest in the company, the investors they demand a higher interest rate, a higher because there is risk in the company, so they want to be compensated for that risk. Okay, so there is an additional discounting impact, 4%, 3%, but so let's say that because they had to be compensated for the extra risk that they are bearing, so they demand 7% more. So overall, they may demand 14%. Okay, so we just in that example, okay, $100 next in next year reduced to 96 today, so there was a discounting of 4%. Okay, but if I take this 14% discounting, so $100 next year is actually only $86 today. Okay, all right. So that's why so I'm talking about basically cost of equity. That's at, at a very simple level without getting into beta and all the fancy things that we're going to talk about later in the video series. All right. So hope you kind of get the notion that free cash flows have to be projected out in the future, and then they have to be discounted to the present using cost of equity and cost of debt as well. But again, we'll get into nuances of valuation later. Okay. So, but essentially, this is what discounting is, because the value of money, okay, because there is this time value of money concept that needs to be applied, right? Okay. So, hope this is all right. So I'm forgetting. So there is one more. Okay. So now we spoke about free cash flow projection. Okay. We spoke about discounting back to the present of those free cash flows. Okay. Using this, say, 14% rate. Okay. So $100 next year is $86 today. Okay. Right. Now let's also talk about what period. I just gave an example of 1 year. Okay. So how would you determine till what period you need to project your future cash flows? It could be 5 years, 10 years, 15 years, or even 20 years. Okay. Say 20 years down the line, $100 would be uh, if I go back here, 20 years down the line, $100 at say 14%, if 14% is the discounting rate, okay, is only $7 today. Okay. All right. At this 14% discounting rate. All right. So how do we determine what period we need to, make this projection? So first thing, let's understand that in DCF valuation, we make an assumption that the business operates as a going concern. That is, the business operates in perpetuity. It would keep on going forever. Okay. But obviously you cannot be estimating free cash flows forever. Okay. That is like done and done. All right. So to estimate, so to project these out, okay, in the future, okay, to whatever period. So determine explicit projection period. You need to understand what stage of life the business is in. Professor Swadhamudaran calls it the Professor Damodaran calls it the corporate life cycle. Okay, you need to kind of understand what stage of life the business is in. Say if the business is a young startup, it's a young growing firm, your projection period, okay, your explicit projection period would be, say, 10 years or 15 years or even 20 years. Okay. Or let's say if you're talking about a stable growth firm like Hindustan Liver or Nestle. Okay. for these firms, they've already like penetrated the market well. They're there in every household. Okay. So for these stable growth businesses, you would estimate a much smaller projection period, say, let's say only 5 years or even 0 years. Okay. But I just said that in DCF, you assume that a business operates in perpetuity. It operates as a going concern. All right. So what you do is after this explicit projection period, okay, finance gives you a formula which is called a Gordon growth model. Okay. So using that formula, and we'll obviously talk about this uh, in a later videos. So using this formula, we estimate the cash flows or the terminal value, okay, after the growth period, explicit projection period. Okay. Right. So one is you estimate free cash flows, say for 5 years, 10 years, 15, 20 years, depending upon what stage of life the business is in. Okay. After that, okay, this formula would make your life easy, would just give you the terminal value of the business. So both the values, the free cash flows from the projection period, this as well as this, okay, they need to be discounted to the present using the discounting rate that we just estimated. Okay. And so that would be the value of your business. So free cash flows in this projection, explicit projection period, plus free cash flows, uh, your terminal value from your terminal value, both discounted to the present using your discounting rate, gives you the value of the equity or value of the business, depending on what valuation method you are using. And again, getting into the nuances, we'll get into nuances later on. But see, this is what essentially what valuation is all about. All right. So just to conclude this first topic, introduction to valuation. So valuation is the present value of its future free cash flows. So first you need to understand what stage of life the business is in. If the business is young, you estimate you take a big projection period. But if the business is stable, then you go ahead with a smaller projection window. Okay. And for that window, you estimate whatever your window is, you estimate your free cash flows. Okay. And then uh, after the projection period, you use terminal value. And using all your free cash flows, you discount your free cash to the present using the discounting rate, bring them to the present. And that would be the value of your equity or value of your business. And again, we'll talk about the nuances later. Okay. So hope that gave some perspective on valuation. Obviously, we'll get into the details as we go along. Many of your doubts that you may have right now, hopefully they'll be cleared as we go along. Okay. Uh, but yes, hopefully it did give you a sense of what lies ahead of us. All right. Okay. So in the next session, we'll cover for this particular healthcare provider. We'll talk about their industry, and then get our hands dirty into their financials, and then go about valuing the firm. All right. Okay. Thank you.